Hello everyone, my name is Janeta Mahu and I will be presenting you the group assignment in subject accounting of business. In this project, we're gonna focus on two companies, which is Alpha and Beta, and we will be presenting the financial performances of these two companies by using the accounting techniques, which are common size analysis and financial ratios. And we will be focusing on liquidity, efficiency, solvency, and profitability. In this slide, we can see the overall profitability of both companies from their income statements. We can see that Alpha net profit is $162.2 million, and it's a slightly less than Beta company, which is $210.4 million. This suggests that Beta company is more profitable during year 2025 and generated stronger earnings from its operations. However, Alpha company is more reliable and is considered be more financially stable because it has lower interest expenses and it appears to rely less on debt financing. This may reduce financial risk in the long term. In the other slide, we can see the balance sheet of these two companies, and we can say that beta companies having a higher total of assets than alpha company. This means that beta company controls more resources and may have a greater potential for growth and expansions. However, beta company also have higher liabilities, which means that it relies heavily more on debt financing than alpha company. So in comparison, in alpha company and beta company, alpha company appears to be more conventional of its financing, specific on its financing approach, because it depends more on equity financing and maintains lower liability. In this slide, we will be focusing on the first financial technique or accounting technique, which is common size analysis, specifically of income statements. We can see that beta is having better profitability, and we can say that beta keeps a larger percentage of profit from each dollar of sales revenue because it achieved a higher margin, which is 23.90%. And in overall, we can say that beta company demonstrates stronger profitability and a better cost control. In this slide, we can see the common size analysis of the balance sheet. And this slide presents that Alpha company is more concentrated in non-current assets, specifically in property, plant, and equipment. This suggests that this company relies more heavily on long-term operational assets. On the other hand, Beta is less asset focused and is stronger focusing on working capital, which including cash, inventory, and accounts receivable. This may provide Beta company with greater short-term flexibility and liquidity for daily operations. What this means in overall Alpha company appears more focused on long-term asset investment, while Beta company demonstrates stronger working capital management.
Hello guys, how are you? I am Zishan and I am here to represent about the liquidity, solvency and efficiency of both the companies Alpha and Beta. So let's start. So in this slide, we talk about the liquidity ratios. As mentioned in this slide, we see that ratios alpha beta. Ratios of working capital for alpha company is around about $94,100, and for the beta company is $144,750. And you can also see the current ratios of alpha company is 2.53 and the beta company is 2.55. Acid test ratio of alpha company is 1.08 and the beta company is 1.06. So the conclusion is both companies show strong liquidity. Beta has more working capital, but alpha has a slightly high acid test ratio. Move to the next slide and we talk about the liquidity analysis. So in this slide we can say that for short term health both companies look solid. Beta has higher working capital at 1044 750 V's 940,100, but the current and the acid test ratios are nearly identical, around 2.5 and 1.1. That means both are can easily cover short-term obligations. So move to the next slide. We can talk about the solvency ratio. As you see, debt ratio of alpha companies to 0.32 and the beta companies 0.36, and also the debt to equity ratio 0.47 for the alpha company and 0.56 for the beta company. And also times interest earned for the alpha company is 23.41 and for the beta company is 19.05. So alpha is less leveraged and more conservative in financing. Beta carriers more debt relative to equity. So move to the next slide. It's about the solvency analysis. In the solvency analysis, we can see breaking down debt. Alpha has 142,140 in total liabilities compared to beta as 194,300. That gives alpha a lower debt ratio of 0.32 v 0.36. Both cover interest well, but alpha's 23.4 times coverage gives it a bigger safety margin than beta's 19.05. So in this slide we can talk about the efficiency ratio. So AR turnover for alpha company is 20.18 and the for the beta company is 14.82. And also days sales in receivable for alpha company is 18 days and for the beta company is 25 days. Inventory turnover for alpha company is 7.67 and for the beta company is 4.91. And also days sales in inventory for alpha company is 47 days and for the beta company is 74 days. And the total asset turnover is 1.83 for the alpha company and 1.92 for the beta company.
Hi, this is Roshan, and I'm here to discuss the profitability and market perspective of both the companies Alpha and Beta. So, first of all, coming towards the profitability, so, based upon the data on the ratios provided, beta appears to perform better financially than alpha across all profitability measures. We are going to discuss this one by one. So, coming towards the first one, gross profit margin, beta has a higher gross profit margin as compared to alpha. That indicates that beta is more efficient at controlling production or operating costs and retains more profit from sales before other expenses. And talking about the net profit margin, beta also has a stronger net profit margin as compared to alpha, meaning it converts a greater percentage of revenue into the final profit. So, talking about the return on total assets, beta's ROA of 50.75% is higher than alpha's, showing that beta uses its assets more effectively to generate earnings. And coming towards the last point of profitability, the return on equity, beta again outperforms alpha with an ROE of 60.12% as compared to alpha's 45.98%, indicating that beta provides a higher return to shareholders on their invested capitals. So overall, beta demonstrates stronger profitability, efficiency, and shareholder returns, suggesting it is financially more effective than alpha. Now, coming towards the market perspective, Uh, Coming towards the market perspective, so based on the market value ratios, both companies have strengths, but alpha appears more attractive from a market valuation perspective, while beta shows stronger earning performance. So, talking about the different measures one by one, alpha has a higher P to E ratio than beta. This suggests investors are willing to pay more for alpha's earning, possibly because they expect stronger future growth. Both the companies have the same dividend yield of 5.07%, meaning investors receive a similar percentage return through the dividends. And coming towards the market price per share, Alpha has a higher market price per share at $75 compared to Beta's 70%, $70, indicating stronger market valuation. And earnings per share, Beta has a higher EPS of $5.11 as compared to Alpha's $4.51, which means Beta generates more earnings for each share outstanding. And coming towards the annual dividends, Alpha pays a slightly higher dividend per share, which is of $3.80 compared to Beta's 3.55, which may appeal more to income focused investors. Overall, Beta demonstrates stronger profitability through higher EPS, while Alpha may be viewed more favorable by investors due to its high P to E ratio, higher share price, and slightly larger dividend payments. The preferred company would depend on whether an investor prioritizes growth and market confidence, which is alpha, or higher earning performance, which is being given by the beta. Thank you very much.
Hello, this is Maraba. I will be presenting about the third part of our accounting of businesses report. So in this part, we will talk about the evaluation of financial health. So the area of our analysis will go with liquidity, solvency, efficiency, profitability, and market perspective. And our purpose to do this analysis is to evaluate and compare the financial performance of alpha company and beta company using a ratio analysis. So first of all, we talk about the liquidity and solvency. So from the liquidity analysis, we could see both companies show strong liquidity positions, and beta company has higher working capital, and alpha company has a slightly stronger ACE test ratio, and alpha company is released less on inventory for short-term obligations. Um, and about the solvency analysis, alpha company has lower debate ratio and debate to equity ratio. Alpha company also shows stronger time interest earned ratio, and alpha company demonstrates lower long-term financial risk. So our key finding of this part, we could find the alpha company showing the stronger financial stability. And then we talk about efficiency analysis. So about the um, Alpha company has faster accounts receivable collection and also higher inventory turnover and lower inventory holding period and better operational efficiency. And about the beta company, we could see slightly higher total asset turnover and also uses total asset more efficiently for sale generation. So our key finding of the efficiency analysis will be alpha company performs better in operational efficiency. So while beta company performs slightly better in asset utilizations. And then we talk about the profitability and market perspective. So beta company performs better in gross profit margin and net profit margin and return on total asset and return on equity. So interpretations is beta company generate stronger profits and shareholders' return. And about the market perspective, we could find Alpha company has higher PE ratio, and also both companies have similar di- dividend dividend yields, and also Beta company may attract growth focused investors.
Okay, excellent. Thank you, Merba. I'm King Ai. Now, based on the previous financial analysis, I will now move on to the investment recommendation for both companies. Both Alpha and Beta are financially healthy companies, but they are different strengths. Alpha company performs better in liquidity, lower debt levels, and overall financial stability. This means Alpha is financially safer and better at handling short-term and long-term obligations. In comparison, Beta company performs better in profitability and shareholder returns. Beta also shows slightly better site utilization and stronger growth potential. Overall, Alpha is the safer company, while Beta offers stronger profitability and growth opportunities. Although Beta Company has slightly higher debt levels compared with Alpha, it performs better in important profitability measures. For example, Beta has a higher net profit margin, return on assets, and a return on equity. This shows that Beta is more effective at generating profits and creating returns for shareholders. Beta also provides stronger growth potential and better long-term returns. Therefore, Beta appears to be the more attractive investment option for investors looking for higher returns. So, both Alpha and Beta are strong companies with different advantages. Alpha company has stronger liquidity, lower debt, and lower financial risk, making it safer option for conservative investors. However, Beta company performs better in profitability and shareholder returns. Even though Beta has slightly higher financial risk, its stronger profitability and growth potential make it more attractive overall. Therefore, our group recommend Better Company as the better investment choice because it offers stronger growth opportunities and better long-term returns for investors. Thank you. This is Group 11.